Welcome to The Close. I'm Zinati Goma, and tonight, the shifting of its strategic priorities and optimizing its operations have paid off for SPAR, steadily recovering from a 1.6 billion rand loss from the botched integration of a SAP enterprise resource planning system at its South African business, and the disposal of its venture into Poland have boosted its operations. We'll be unpacking that performance with Group CEO Angelo Swartz. Then we'll bring you insight into Boxer's JSE listing and what investors can expect from that listing. Boxer CEO Marek Masoyada has those details for us. First up, though, your news-making headlines. Pick n Pay has concluded its two-step recapitalization plan. The first was a rights issue in August. That move raised 4 billion rand. And today, the second step was completed with the listing of Boxer. Pick n Pay raised 8.5 billion rand from the sale of the firm's shares. The recapitalization plan was completed in just 9 months. CEO Sean Summers says this is an extraordinary milestone for the group and reflects a shareholder confidence. On Boxer coming to market, it's the first listing of a soft discount retailer in South Africa. The firm has grown from 35 stores and a turnover of 800 million rand in 2002 to 500 stores and an annual turnover of 40 billion rand. The listing allows Boxer to access local and international markets, supporting its plan to double its store footprint and grow its market share. Boxer currently has about 68% of the discount grocery retail market. SPAR has bagged higher earnings for the year to end September. The grocer posted an 11% rise in headline earnings per share. That's as the group has made significant strides in its strategic priorities. This includes optimizing operations to achieve growth. But while there has been progress, the firm has opted to not declare a dividend, as it says more work still needs to be done. Higher chrome production and sales have given Tharisa a boost. The miner has reported a near 30% jump in earnings before interest, tax, depreciation and amortization. That's as the group's platinum group metals division came under pressure. Output there was largely flat, with revenue sharply declining as a result of lower PGM basket prices. But Tharisa is hopeful that PGM prices over the next year or two will rise thanks to increased demand for hybrid drivetrains. Nampak has offered some clarity on the accounting hits it took in its 2024 financial year. The packaging group says there were several business events and some non-recurring costs in the second half that adversely impacted headline earnings. These included cyber recovery and security costs, retrenchment and restructuring costs, and additional foreign exchange losses in Angola. The update follows the release of an earnings projection yesterday, in which the company indicated that annual headline earnings per share from continuing operations would be around 31 rand. But the market had expected more from the group, with the company's counter ending yesterday's session over 12% lower. Investors have, however, taken some comfort from the details published today, and the stock has clawed back some ground to close 8.4% to the good. Growthpoint has noted a decrease in vacancies. During the group's first quarter, vacancies improved to 8.2%. That's from 8.7% at the end of the firm's 2024 financial year. South Africa's biggest real estate group says it is seeing some green shoots in the office space. Vacancies in that portfolio reduced to 14.2% from 15.1%. And it's the first quarter post-COVID that it didn't see tenants reducing space. Looking ahead, Growthpoint is eyeing an improved operating environment, but has indicated that high interest rates, both locally and globally, remain a challenge for distributable income per share growth, which is still expected to decline by 2 to 5%. Further afield, the U.S. Federal Trade Commission has opened a broad antitrust investigation into Microsoft. This including its software licensing and cloud computing businesses. Here's more detail in this package report.
US regulators have opened an antitrust investigation into Microsoft. A source told Reuters the US Federal Trade Commission will look at its software licensing and cloud computing businesses. The probe was approved by FTC Chair Lina Khan ahead of her likely departure in January. However, the election of Donald Trump as US president leaves the outcome of the investigation up in the air. He is expected to appoint a fellow Republican with a softer approach towards business. Sources confirm the FTC is examining allegations the software giant is potentially abusing its market power in productivity software. That's by imposing punitive licensing terms to prevent customers from moving their data from its Azure cloud service to other competitive platforms. The source added the FTC is also looking at practices related to cybersecurity and AI products. Microsoft declined to comment on Wednesday. Competitors have criticized Microsoft's practices they say keep customers locked into its Azure cloud offering. NetChoice is a lobbying group that represents online companies including Amazon and Google, which compete with Microsoft in cloud computing. They've criticized Microsoft's licensing policies and its integration of AI tools into its Office and Outlook. Google in September complained to the European Commission about Microsoft's practices. It argued it made customers pay a 400% markup to keep running Windows Server on rival cloud computing operators. Bloomberg said the FTC has demanded a broad range of detailed information from Microsoft. US antitrust regulators have been on a recent campaign against allegedly anti-competitive practices at big tech companies. Facebook owner Meta, Apple and Amazon have all been accused by the US of unlawfully maintaining monopolies. Alphabet's Google faces 2 lawsuits, including one where a judge found it unlawfully hurt competition among online search engines. It's unclear whether Trump will ease up on big tech, although his first administration launched several probes.
And Mexican President Claudia Sheinbaum said Mexico would retaliate if U.S. President-elect Donald Trump followed through with his proposed 25% across-the-board tariff. A move her government warned could kill 400,000 U.S. jobs and drive up prices for U.S. consumers. Here's more detail.
Mexican President Claudia Sheinbaum said Mexico would retaliate if U.S. President-elect Donald Trump followed through with his proposed 25% across-the-board tariff. Trump had said the tariffs would remain in effect until the flow of drugs, particularly fentanyl, and migrants into the U.S. was controlled. Mexico has warned the tariff could kill 400,000 U.S. jobs and drive up prices for American consumers. Trump's proposed tariff could violate the terms of the U.S.-Mexico-Canada Agreement on Trade, which the country signed in 2020 when Trump was president. That deal continued the largely duty-free trade between the 3 countries. Sheinbaum said she was confident the agreement would stand. Mexican Economy Minister Marcelo Ebrard, speaking alongside Sheinbaum, said the tariff hike would deliver a hard blow to the automotive sector's top cross-border exporters, including Ford, General Motors, and Stellantis. Ebrard noted that nearly 90% of pickup trucks sold in the U.S. are made in Mexico and would see a price increase. These vehicles are popular in rural areas that overwhelmingly voted for Trump. Sheinbaum and Trump spoke by phone later on Wednesday, with the 2 discussing topics at the top of Trump's agenda. In a post on Truth Social, Trump said Sheinbaum, quote, agreed to stop migration through Mexico and into the United States, effectively closing our southern border. He described the conversation as very productive. Sheinbaum later responded on X that on the call she had laid out Mexico's migration strategy, which, quote, attended to migrants before they arrived at the U.S.-Mexico border. She added, quote, Mexico's stance is not to close borders, but to build bridges between governments and their peoples,